were you worried about titling it this way? Or tell us what you mean by titling it that.
Well, people in this country are fed up with the level of taxation. They pay income tax, they pay capital gains tax, they pay alternative minimum tax, they pay intangibles tax, sales tax, real estate tax. I could go on. And when they die, they can't believe that now Uncle Sam's going to step in and take 55% more of what they have left. And so I wrote a book to show people that there are legal ways, legitimate ways that they can truly disinherit the IRS.
Yeah, and nobody really...
From the studios of WLRN Public Television in South Florida, this is the national award-winning Business Exchange. Welcome to the Business Exchange. In today's Money segment, E. Michael Kilbourn, author of Disinherit the IRS, will tell you how to preserve your wealth and pass it on to your good-for-nothing heirs, whether the IRS likes it or not.
The truth is the biggest villain in estate planning is not the IRS, it's procrastination.
So the IRS is just doing its job, and unless people do their job, hey, the IRS gets to, rake it all in.
Sure, estate taxes are largely optional if people take the time.
They're optional.
If they take the time to learn how to avoid paying them.
Well, still ahead on the Money Cast, taxes are, of course, unavoidable, but we do have some tips to make tax time maybe a little less painful.
That is right. Our next guest, Michael Kilbourn, will explain. You won't want to miss it. Keep it here on Bloomberg.
Michael, good morning. Good to see you.
Good morning.
We're talking about estate planning, which ranks right up there, I think, with most people, right in there with the root canal.
Well, indeed. In fact, most people think of estate planning as death planning, and truly, if you do it right, it's living planning. And in my book, Disinherit the IRS, I show people how to make it a living plan.
It's tough, though. I think a lot of people avoid it because they think it's so complicated. I know when my husband and I sat down to do our will, I just thought, first of all, we don't have that, at this point in life, why are we so worried about it? And it turned out to be a very complicated endeavor.
Well, the truth is, if it's done by a professional, it can be made simple. We can devise a plan that is really quite simple and leaves you in control of your estate for your entire life.
What are some of the biggest mistakes people make when they sit down to make an estate plan?
Well, one of them, of course, is not having any plan at all, not having a simple will or trust to map out what they really want to do.
Which is pretty common.
And last year, over 70% of the Americans in this country who died did so without a will or trust or anything. In fact, they had no plan. And a surprising large number of those were college-educated Americans.
With the Bush presidency, Dean was asking during the break, do you think we're going to see some big changes in terms of the inheritance tax? He's talked a lot about doing away with that.
I see some changes coming. I don't see big changes. I see tax modification, not tax elimination. The truth is that there are two tax systems in this country. Now, I don't mean one for the rich and one for the poor. I mean one for the informed and one for the uninformed. And in Disinherit the IRS, I try and show people how to legally disinherit the IRS.
And you do it primarily through the use of trusts.
Trusts are one. We have things like family limited partnerships that will help you remain in control of your assets for your entire life.
I wanted to ask you, but when you're dealing with a trust or a limited partnership, how much control do you really have to give up and still satisfy the IRS requirements?
Well, with proper planning, we can set it so that you give up no control. How's that with a family limited partnership? But we might want to set up a trust where you would be the grantor and your spouse would be possibly the trustee of that trust and an income beneficiary. So now you've taken assets out of your estate, and yet you have access through your spouse, a little incentive to stay together if you're married, and basically your spouse can get to the assets if they're needed, and if not, they continue to grow for the benefit of your children. But they're out of your estate, and you have control through a spouse, and that's using trusts. But if we use a family limited partnership, you and your spouse can be the general partners as to 1%, give away over time 99% of the limited partnership shares to family members, and you end up in control even with 1%.
The real devil here is the procrastinator.
Well, that's true. In fact, the biggest villain in estate planning is not the IRS, it's procrastination.
While the 2001 Tax Act has lessened the burden of the estate tax, Americans still need to take estate planning very seriously. Michael Kilbourn is author of Disinherit the IRS. He joins me now with some advice. Thanks for being here.
Welcome.
So you note in the book that people are only worth about half what they think they're worth because of the effects of the IRS on their wealth once they're gone.
That's right. If you have an estate that exceeds the exemption amount, which currently is $1 million per individual or $2 million per couple, you're exposed to a state tax that starts at 41% and quickly works its way up to 50%. And get this, it's due within 9 months after you leave this world.
Let's talk about the changes that are made, because people may be under the misimpression that things are going to be a lot easier for them in a very big way, when in fact the changes that have been made aren't all that great in the law.
If you're referring to the 2001 Tax Act, it's quite convoluted. In fact, some commentators have called it a fraud on the American taxpayer. And basically it calls for various changes in levels of exemption, and then in 2010, theoretically, the estate tax goes away for that 1 year, and then it comes back in the year 2011, roaring back. In fact, it drops back to the levels of pre-2001, so that now your exemption goes up to here, and then it drops back to here. And it's such nonsense that most experts believe that we will see a change again, possibly next year, in the estate tax laws going forward. I believe that sanity will prevail, and when the congressmen are looking next session at maybe extending the provisions of the 2001 Tax Act, they will actually carve out the estate tax, maybe raise the exemption from $1 million to maybe between $2 and $3.5 million per individual, and then freeze the rate at 49 or 50% going forward, and that will be our change. And we won't have that 2010 nonsense. Hopefully they'll wipe off that elimination of the step-up in basis, because who the heck's going to be able to track their basis going forward for their family? I mean, it's impossible.
So how do you disinherit the IRS? How do you make
Are there any ways of getting around the estate taxes?
Oh, there's quite a few ways to get around the estate taxes that are covered in my book, Disinherit the IRS. And there's simple ways. Now, you could have trusts that you still have access to, but you take assets and give them for the benefit of your family. We can show you how to have access to an irrevocable trust. You have family limited partnerships. But if you want a simple plan, it's basically you might have an irrevocable trust by life insurance on your life to pay the tax, so Uncle Sam gets fully paid, but your family gets the benefit of all of your assets. And the life insurance comes income and estate tax free to your family.
Good information. We thank you so much for joining us today.
My pleasure. Thank you.
Your money. Learn how to make it, manage it, and multiply it. In partnership with the Chicago Tribune's business section, CLTV presents a personal finance show just for you. This is Your Money.
So are these simple little things to do, or is it a complicated process typically one has to go through?
Actually simple. There are things you can get more complicated on, and the larger your estate gets, probably the more things you need to do, but actually you can devise a simple plan, one that would be quite legal and ethical and all that. And so bottom line is that you can avoid estate taxes if you take the time to read my book, and you can ultimately disinherit the IRS.
Are these one-time things you do, or is it all part of your tax planning that goes on sometimes for a lifetime?
Well, it's actually, tax planning is something you should continue to do through your lifetime, because tax laws, as we well know, change. So it's an ongoing process, but you can do little parts now and more later. The problem is most people think of estate planning as death planning, and the truth is, if it's done right, it's living planning. You can have living benefits, take care of loved ones, and even maybe take care of charity, all in a single plan, and it can be truly synergistic.
People look at the Congress, they think something's going to be passed. Do I have to really worry about this? What would you say to that?
Right now, we think what's going to happen is that the federal government will actually devise a plan that raises the exemption for most people to $2 million, maybe as high as $3.5 million, and so double that per couple. And what that will mean is we'll be reduced down to the 1% will be taxed of the taxpayer.
And even if the feds might not tax you that much in the future, the states want to get their hands on your money.
And that's a real problem, because the states used to get a bite of the federal apple, so to speak, and they called it a sponge tax, and it was sort of transparent. But now the federal government, as of the 2001 tax law, eliminated the states' bite of the apple, so the states are actually repassing their own separate estate tax. So now we're going to end up with 2 estate taxes that may even be more than what we had before.
Enough to scare you. Well, Disinherit the IRS is the name of the book. Don't die until you've read this book, as it says on the cover. Okay, Michael Kilbourn, thanks.
You're welcome.
Give me the elevator pitch on why I can't just give what I want to whom I want. What are the roadblocks?
Well, you've got all the taxes you pay during your life: sales tax, income tax, capital gains tax,
right.
You name it, and then you die, and Uncle Sam wants to take, right now, 49% of what you have left over the certain exemption amount.
Right, and what is that exemption?
there's a one-time exemption of $1 million per grantor. So if you're married, that's $2 million.
Right.
And that's just one time. You can wait till you die. You can chip away at it while you're alive. You can give it all at once while you're alive. And then there's the $11,000 per year exemption that you can give to anybody. If you're married, it's $22,000.
Okay. So key mistakes.
Key mistakes. Well, obviously the big one is not having any plan. And as we know, last year, 70% of the people who died in this country did so without any plan. 70%. And a large number of those were college-educated Americans.
Okay.
But here's a big mistake.
Yeah.
A big one is that people leave things outright. And I believe that nobody should leave anything of any consequence outright.
Okay.
They should leave it in trust. Because by leaving it in trust, you can protect your heirs. And let me give you an understanding of that. If you leave things in trust, the heir might say, well, gee, you've got strings attached to this thing, and that may be true, and maybe you want to do that because you have a spendthrift heir. But let's talk about leaving things in trust, in separate trusts for each of your children, making them the trustee of the trust and an income beneficiary. And as such, they'll be able to have the income from the trust and the principal as needed. And what you're doing, though, by doing it that way, is essentially protecting them, because whatever's in trust is free from the claims of creditors, predators, divorce, and if we do it right, whatever they leave in trust will go on to the next generation, their children, your grandchildren, without another layer of tax.
Very quickly, we have a half a minute left. Tell me why you think that owning property jointly is a bad thing.
People think that joint property allows them to avoid probate, but all you're doing is delaying probate, and then you have unintended heirs. I mean, you die, your spouse maybe gets the asset and then remarries and then dies. Well, who's going to get the asset? You also have liability issues. We had a client that had all his assets in joint property, and he had his car that way, and he hit a school bus, killed some kids, killed him, and guess who they sued?
Oh,
her.
Yeah.
There's other issues, big issues. So joint property is not the way to go. In fact, as I said in my book, that people can discover those other issues.
Very good. Michael Kilbourn is the president of Kilbourn Associates and the author of Disinherit the IRS. Well, even